Welcome to your deep dive. If you've glanced at the market recently, you know the atmosphere is, well, it's tense.
Tense is a good word for it.
Yeah, what you're seeing is the market going through this massive structural split. It's a profound bifurcation between the really brutal short-term pain and this accelerating long-term infrastructure narrative.
Right. And our mission today is to really dig into that,
Sure.
to analyze that widening chasm between the spot market, which looks awful, and this relentless accumulation that's happening at the corporate level.
That's the core of it. We're here to answer one simple question for you. Who is actually winning the battle for Bitcoin supply?
That structural divergence is the whole story right now.
Yeah.
We're just witnessing high-frequency traders, the macro tourists, reacting, maybe overreacting to Fed signals.
While at the same time, the institutional and corporate players are treating every single dip as a buying opportunity, a permanent one.
Exactly.
Okay, so let's start with the immediate crisis, because you can't ignore it. Bitcoin just broke below $90,000.
A huge psychological and technical level.
A huge one. And just like that, it erased all the year-to-date gains for 2025. I mean, that is a massive psychological blow.
For anyone in retail who is expecting, smooth sailing after the halving, this is a shock.
Oh, for sure. The sentiment just flipped from anticipation to basically outright capital preservation.
And unfortunately, the charts are just reinforcing that fear. We now have confirmation of the death cross on the daily.
Okay, for anyone not deep in technicals, just break that down. What does that mean in simple terms?
It's when the short-term 50-day moving average crosses beneath the longer-term 200-day. Now, it's a lagging indicator, but the problem is
It triggers the bots.
it triggers the bots, it causes automated algorithmic selling pressure, which just makes the current volume so much harder to absorb.
And it doesn't stop there, does it? The chart analysts are also pointing to this pattern they're calling a broadening top, or a megaphone.
The megaphone, yeah. It emerges when volatility just explodes. You get higher highs and lower lows.
So it's not consolidation, it's distribution. People
Right.
are selling.
Exactly. It's distribution. And when that pattern resolves to the downside, like it seems to be doing, it implies a pretty significant measured move lower.
So what's the level everyone's watching? The line in the sand.
It's that zone between, say, 88,750 and 89,500. If that fails to hold, the consensus fear target is somewhere in the vicinity of 75,000.
Wow. Okay, so that's why there's so much panic in the market structure today.
Absolutely.
And this panic, it's quantifiable, right? This isn't just retail getting spooked. We are seeing major capital flight from traditional finance.
For 4 consecutive days now, net outflows for the spot Bitcoin ETFs.
And if you add in all the other crypto products, the daily capital flight was what? Something like
$437 million. It's a shocking number.
Yeah.
And BlackRock's IBIT alone saw $145 million of that go out the door.
So that tells you exactly what kind of capital is leaving. You called it tourist capital.
That's what it is.
But hold on, let me challenge that for a second. Weren't these large allocations made on the premise that Bitcoin is this, sophisticated, non-correlated store of value?
That was the pitch.
So why are they fleeing at the first sign of a hawkish Fed? Doesn't this just prove the bear case that it's nothing but a levered risk asset?
I'd say it proves that for this specific cohort, the adoption thesis is incomplete. You're right, they are treating it like a high beta tech stock.
So when the Fed hints at higher for longer,
They cut exposure. These are the tourists, the institutions, driven purely by short-term momentum. For them, Bitcoin is a disposable risk asset. It's not their permanent inflation hedge. Not yet.
their money is governed by quarterly performance, not...
Not multi-year conviction. And that distinction, that's what leads us directly to the other side of this story.
And that distinction is everything. Because while those ETF tourists are running for the exits, public companies are stepping in. They're aggressively acting as the buyers of last resort, building what we're calling the corporate Treasury Firewall.
This is where the real structural supply shock is happening.
You have to start with MicroStrategy. They just set the standard.
Their latest buy is a masterclass in conviction. They just bought another 8,178 Bitcoin.
And they funded it by issuing stock and debt. They raised over $835 million just for this.
Right, but here's the most critical detail. The one thing you really need to take away from this deep dive.
What's their average price on this buy?
Their average purchase price for this tranche was $102,171 per Bitcoin.
$102,000. With the spot price hovering around 90, that is a stunning premium.
It's a statement. They are effectively putting a floor under the market and signaling that they believe the intrinsic value is far, far higher than where it's trading today.
So this isn't just buying, it's a declaration of structural supply removal.
Exactly. They are deliberately swapping fiat for Bitcoin, maximizing their Bitcoin per share, regardless of what the price does this month.
And their total holdings are now? What's the number?
Nearly 650,000 BTC. They've permanently taken over 3% of the total 21 million supply out of circulation. It's a supply shock engineered on corporate balance sheets.
And this model, this debt for BTC pivot, it's spreading. Marathon Digital just announced a huge $700 million offering.
A convertible senior note offering, specifically.
Okay, explain that. For people who aren't familiar with that instrument, what does using a convertible senior note really mean here?
It's basically debt that gives the bondholder an option to convert that debt into the company's stock later on.
Which is brilliant for Marathon.
It's a great move.
Yeah.
They're leveraging cheap access to fiat to debt to acquire a scarce non-fiat asset.
Yeah.
And they explicitly said the capital is for acquiring more Bitcoin. They're adopting the MicroStrategy model.
And this conviction is going global. We're seeing Metaplanet in Japan doing the same thing. They just secured a $100 million Bitcoin-backed loan to buy more.
That's a serious leverage play. And beyond just pure accumulation, we're seeing these really novel operational uses. You have to look at Genius Group, GNS.
This one is fascinating. They combined a $10 million treasury purchase with a really interesting shareholder defense mechanism.
They launched a Bitcoin loyalty payment program.
Explain the genius behind this move.
It's a brilliant tactical play. They're offering shareholders 10 cents per share, paid in Bitcoin, if they remove their shares from the lending pool.
So they're literally starving the short sellers of ammo.
They're starving them of supply. They're using Bitcoin not just as a reserve asset, but as an active tool for shareholder alignment and defense. They're even suing some trading firms over it.
Meanwhile, you have Nano Labs in Hong Kong creating a closed-loop system. They're repaying bonds with Bitcoin.
Right, 300 BTC plus some compensation. It minimizes their need to convert back to fiat, which carries its own risk.
And you can't forget Semler Scientific, the healthcare company. They're still building their reserve up to over 1,200 BTC now.
And they even created a metric for their shareholders, BTC yield, which they're reporting at 37.3%. They're framing Bitcoin accumulation as an accretive business strategy, showing quantifiable value.
These aren't just trades. These are permanent strategic shifts in how corporate finance works.
So if we connect all this, this corporate shift, to the bigger picture, what does this ongoing institutional plumbing tell us about the long term? Especially when the price is still so wild.
It tells us the foundations are being laid, completely irrespective of the daily price. Look at Goldman Sachs.
A great example.
They just announced they're spinning out their digital assets platform, GSDAP, into a standalone industry-owned entity. They're partnering with TradeWeb markets.
And this is a really critical sign of maturation in TradFi. The goal isn't just for Goldman to be more efficient internally.
Right. They want to create a neutral, industry-wide settlement layer.
Exactly. For things like tokenized bonds and collateral, Goldman is basically handing over the keys to a third party. It minimizes the fear that one Wall Street giant controls this new critical infrastructure, which encourages everyone else, all their rivals, to get on board.
And on the regulatory side in the U.S., we're finally getting some signals of clarity that could really unlock the next phase of development.
You're talking about former SEC Chair Paul Atkins and his Project Crypto.
Exactly. He's proposing a dynamic classification system.
The key insight there is just the acknowledgement that investment contracts don't last forever. A token might start as a security when it's being sold to raise funds.
But as the network decentralizes,
as it becomes widely used, it can evolve into a commodity. And that provides a real pathway for projects to get regulatory certainty, moving away from the old regulation by enforcement model.
And beyond just classification, there's the push to make Bitcoin actually usable for, everyday things in the U.S.
Block's Bitcoin is Everyday Money campaign.
Right. They're advocating for a tax exemption, a de minimis exemption on crypto transactions under $600.
Which just simplifies everything. You have to think about the practical side of this. It means you wouldn't have to track and report capital gains to the IRS every time you bought a coffee.
It makes real-world spending actually feasible.
And the fact that the incoming administration has signaled they're receptive to exploring this, that suggests there are real political tailwinds for usability now.
Okay, so the long-term view, built on these corporate and institutional rails, it looks strong. But we have to address the near-term volatility, the contagion risks that are brewing in some of the adjacent markets.
Absolutely, because that's where the price action can really amplify fear.
And the institutional access race is moving way beyond just Bitcoin and Ethereum now.
Oh yeah. The altcoin ETF race is officially on, and it's starting with Solana.
We have Fidelity launching FSOL with a competitive 0.25% fee, and VanEck is launching VSL with a fee waiver to start.
It's a fascinating land grab because BlackRock has come out and said they will not be pursuing a Solana ETF at this time.
Which leaves this huge opportunity for Fidelity and VanEck to just dominate that specific asset class before the biggest players even step in.
We're also seeing a really clear split, a bifurcation in the mining sector. It really reflects strategic adaptation.
HIV Digital is a great example. Their pivot to high-performance computing and AI is clearly working. Their revenue surged, 285% year over year?
That shift into AI compute is proving massively profitable for them.
But on the other hand, you have BitDeer posting a huge net loss, over $266 million, even though their revenue tripled.
And that loss just reflects heavy, heavy investment. They're pouring money into scaling their infrastructure, into R&D. We're also seeing rig producers like Canon report better than expected revenue.
Which tells us that the serious operators are still spending capital. They're upgrading for efficiency, betting on the future price. Even if short-term profits are a struggle, they are not retreating.
And finally, we cannot ignore the immediate systemic risks that are still brewing in DeFi.
A reminder that the synthetic yield space is still structurally fragile.
Very fragile. The stream finance collapse, tied to a $93 million loss, has triggered an estimated $285 million in total debt exposure across that ecosystem.
Okay, so how does a $93 million loss balloon into $285 million in debt? You have to explain the mechanism here.
The mechanism is rehypothecation. It's the critical factor. It's when collateral that's deposited for one loan gets reused as collateral for another loan.
And another, and another.
And often multiple times down the chain.
Yeah.
It creates this complex nest debt. So when the initial collateral, that $93 million tied to stream, when that failed, it created a cascade. The losses rippled through multiple layers of loans.
And the main casualty here was the Elixir protocol.
Yeah, they had 65% of their DUSD stablecoin reserves tied up in stream-related assets. They've had to pause withdrawals and basically sunset the whole stablecoin.
It's a very potent reminder that while corporate treasury adoption is clean and simple,
the synthetic yield products in DeFi still carry a ton of systemic risk, and it's all amplified by these looping, leveraged mechanisms.
So all of this, it really raises an important question for you to consider. What is the lasting takeaway from this extreme market divergence? You've got the volatile price on one hand, and this fundamentally strong balance sheet data on the other.
The lasting takeaway is that the market is just defined by this violent clash between two totally incompatible viewpoints.
The bear case, that's driven by macro instability, momentum traders, the ETF tourists.
They're exiting in fear. But the bull case is being driven by these incredibly disciplined price-agnostic corporations that are using leverage to execute a structural, and I would argue permanent, supply shock.
The coins are actively rotating right now. They're moving from what you'd call weak hands.
The momentum traders, the ETF redeemers, with a short-term view.
To strong hands. The corporate treasuries and strategic funds who have a multi-year mandate to just acquire and hold.
And that foundational adoption curve is accelerating.
Yeah.
It's becoming permanent, regardless of the price pain that is dominating the headlines today.
It's a very compelling long-term thesis, one that really shifts the focus from the technical charts over to corporate balance sheets.
It does.
So before we wrap up, here's one final provocative thought for you to consider. And this one ties together politics and infrastructure.
Okay.
Trump Media and Technology Group, DJT, is reportedly in advanced talks to acquire Bakkt,
The crypto trading venue owned by IC.
the parent company of the New York Stock Exchange. Exactly. Bakkt shares just skyrocketed 162% on the rumor.
Wow.
So if a high-profile political and social media ecosystem like that integrates crypto infrastructure directly, what does that mean for the regulatory posture going forward? What kind of industry-friendly policies might follow that level of integration? Something to chew on as the market continues this chaotic rotation.